Good evening, everybody, and welcome. Today is another Thursday Talks episode. Today is just 2 days after the Canadian budget, a budget that we all waited with bated breath for quite some time, and it finally delivered. But today we have two people on our panel who will let us know whether the budget that's high on expectations did it actually deliver. So with us today is Daniel Schwanen, VP Research at CD Howe Institute, and Jennifer Poon, Director Advanced Planning at Scotiabank. My name is Vijay Thomas. I am the president of the Indo-Canada Chamber of Commerce. As a day job, I run a software company, and helping me today is my colleague, also a person on the board of directors, Priya Dhawan Chahal, who, as her day job, works for Scotiabank. She's a district vice president, and we will hear from her later in the show as well. So without further ado, what is today's program about? I mean, this is Canada's first federal budget in 2 years. As I mentioned, it raised high expectation because of its ambitious goals, and it has jettisoned government orthodoxy on high spending. And we have today people on the panel that might question some of that, and I would love to see all perspectives, different perspectives on the subject. The budget the Deputy Prime Minister and the Finance Minister, Chrystia Freeland, tabled on Monday is about dealing with the immediate threat of COVID-19 and then repairing and revitalizing the economy with an eye to the future. The budget proposes $101.4 billion in new spending over 3 years to kickstart the economy and transition to a green economy, and $30 billion over 5 years and $8.3 billion per year after that to create and sustain a national childcare program. The goal is to reach the $10 per day childcare service by 2025 to 2026. Some of you who might know of the Quebec model, I personally lived in Montreal, so I do understand that this is not something that, it does work in some parts of the country already, so it's not entirely a pipe dream, but it is already working in some parts of the country. Deficit has ballooned. It is at $354.2 billion in 2020-2021, $154.7 in 2021-22, and expect to gradually decline to $30.7 billion in 2025 to 2026, approximately 1% of GDP. Debt to GDP ratio soars above 50%, then falls to 49.2% by 25-26. And to discuss all this, again, we have Daniel Schwanen, Vice President Research, CD Howe Institute, and Jennifer Poon, Director Advanced Planning at Scotiabank. Moving on, a little bit of a disclaimer here, especially if some of you are going to go and put your money in some assets and then say, we heard this at the ICCC webinar. Right here, the information is provided for general information purposes only, does not constitute legal or professional advice. There's some stuff in the middle. I'll let you all read it. Right at the bottom, the views expressed by the speakers are their own personal opinion and do not necessarily reflect the official policy or position of the ICCC. So with that out of the way, I'm going to make it clear, if you try to sue us, you're probably on a very weak wicket, so that's out of the way. Now, what are we going to do today? We'll have Daniel go ahead first. He's going to speak a little bit. He's going to talk more about economic policy and economics and how the budget's going to influence that or influences it already. Jennifer is going to talk more about tax policy and how this is going to affect us as business owners, as citizens of Canada, and also probably members of the Indo-Canada Chamber of Commerce. So a little introduction about Daniel Schwanen. He's an award-winning economist with a passion for international economic policy. He's a vice president research at CD Howe Institute. It's a very renowned Toronto-based think tank. He's spearheading institute programs focused on the link between Canada's international trade and investment policy and Canadian standard of living. He joined the CD Howe Institute in 1990. He worked in the 1990s and earned him foreign visitorships in the United States, Japan, and Australia. He returned in March 2011 as Associate Vice President, Trade and International Policy. He got promoted to Assistant Vice President, Research in January 2013, and currently holds the position of Vice President, Research as of June 2014. So Daniel, over to you. And if I have missed anything in your introduction, please feel free to add to that. And over to you. Daniel, I think you're on mute. You're on mute.
Of course I am. I apologize. Thank you, Vijay. And you remind me I should maybe shorten these bios in the future, but that was a very kind introduction. And also thank you for giving us the budgetary big picture. And so I can launch directly into some, an overview of what we think about this budget and where it leads us, especially. So, in fairness to the finance minister, she and other, of course, finance ministers and officials around the world are navigating what is still a very uncertain period. And in fairness, also, the deficit that you mentioned, 350 billion or so, 354 in the fiscal year just ended, is actually less than some commentators had feared. And I say feared, I'll explain why in a minute. And in terms of this coming year, less than feared in the sense that economic growth was a bit stronger than expected towards the end of last year, early this year. And obviously that has fed into revenues. And so from that point of view, it's good. There is, or it's understandable, there is also a large deficit by any historical standard that are non-war or non-depression standards. Large deficit coming this year, and that is due, I think, to a lot of uncertainty. So if the economy recovers more quickly, the programs that the finance minister is continuing that are supporting individuals, wages, businesses through this particular period that is still difficult, then who knows, maybe the deficit can be lower this year if we get out of this quicker. So a familiar calculation around the world. Having said this, some criticism. Number one, Canada, there's some dispute about this, but our analysis and even the Department of Finance's analysis shows that Canada has spent a lot of money relative to the hardship that we suffered, I would say, relative to the health outcomes. We spent a lot more money than many of our comparator countries. We've been more generous, maybe, with our spending. We didn't want to take any chances. That is fair enough. But, as a result, better to overshoot than undershoot, maybe in time of crisis. That's a political choice. But as a result, and as a result of also the monetary stimulus that has accompanied this, the Bank of Canada purchasing government bonds, federal, provincial, et cetera, we have a lot of Canadians that are awash in cash. They're sitting on a lot of savings. Maybe all that stimulus was, and those are not necessarily the Canadians that need it the most, sorry to say that. And so, the reality is the question was this all needed? So that's one criticism. The other criticism looking forward is that really there were plans out there, including our own, that we proposed, maybe a little bit too austere, I don't know. Don't want to criticize my colleagues who published it, but it was realistic, that would have gotten us much quicker to the 30% federal debt to GDP ratio that we had prior to this crisis. Now, that seems very low. The problem in Canada is that we have a lot of provincial debt and a lot of provincial obligations that are coming down the pipes due to demographics and so on. We do need to leave that fiscal room to maneuver. I'm not so sure that the budget does this. So, we had proposed a plan to get back to 30% debt to GDP ratio, the federal debt, by 2040. Now it looks like it's going to be achieved only by 2055. That's a long time, and it assumes basically, we think that, we're not going to face any crisis over the next 30 years, that everything's going to be hunky-dory, that we're going to get back on track with respect to growth. And, I'm not sure that that's realistic historically. that is going to be that smooth. Having said this, you know, depending on your view of the world, it's not outlandish. It is a path back towards some kind of if not balanced, then steady debt to GDP ratio, and the government emphasized that. It's just a very, very long-term path. So, you know, higher spending, modest revenues, because some of the measures that are supposed to stimulate economic growth that I'm going to go over right now are really not expected to raise growth that much in the short run. There's not a lot of revenue increases. They're going after, a little bit of the digital economy, a little bit after tax evasion, and Jennifer, I think, is going to talk about some of the tax implications. But the reality is that the government is also not, leaving that for future generations, frankly, to sort out. If you're talking about the next 30 years and how we're going to pay for all of this, and so that is a major, I would say, macroeconomic concern. Having said that, in the current situation, it's not outlandish. I'm going to leave it at that. It's a choice, but I think it's going to make our life more difficult down the road. In terms of economic growth, a number of programs focusing, I think, on the social and the training and the digital economy side of things. You heard a little bit about from Vijay about the daycare program. One of the issues there is that it's a good idea in general. Like from an economic point of view, it's a good idea. It's a good idea when you try to look at the populations, the people that have suffered the most through this pandemic, and frankly, you get quickly to those are people working in certain industries with a certain skill set, and then families with young children at home. And so we've long written about this type of program, about the Quebec program that you mentioned. It's quite an understandable and an economic boost to families and to the country to bring that program on. The only problem is, or the main problem is, it's not going to happen anytime soon. And so, I might have preferred something like pharmacare or Dentacare that you could implement more quickly, that have been working on for a long time, and that might help people right now, that are out of a job and so on. Be that as it may, it's not a bad idea. It's just not going to help growth right now, and it might even leave people disappointed if they can't get the provinces on board. A lot that's relatively, but new investments in youth has also suffered through the pandemic, and that's to help with student debt, after school programs for the younger ones, and more focus on work integrated learning. And there might be programs in there that are really of interest to your business, including trying to link science students and graduates to the business world and small businesses in particular, and that will be coming relatively quickly. There's some support for small businesses and medium-sized businesses, very much for technology adoption, to support entrepreneurship by certain groups that are, let's call them, under-entrepreneured, if that's the right, if we're coining new terms all the time. So, but I think in general, some good programs there. And last but not least, some tax breaks for new business investment. I don't know, Jennifer, you're going to cover that. Okay, great. That I think are well timed. Personally, given that the dearth of business investment is a major problem in this country and has been for a few years now. Now maybe they're looking at future taxes because of the big debt, and they're worried. Maybe they're also looking, and I don't want to be negative here, but about this whole green transformation that the government is promoting through major investments, including also credits for businesses and subsidies, research and development, etc. And for a natural resource-based economy that leaves, I think, a lot of Canadians still wondering, and the government just doubled down on its greenhouse gas emissions targets, just I think today or in the past couple, post-budget. So now we're going to be like even more making an effort to become green, including through procurement practices. So there's a lot of those structural changes in Canada that I think are, you know, are necessary for the long run. There's no question about that. But, you know, it means that in the middle of trying to recover from this pandemic, we're also going to undergo all these changes. I didn't even mention the investments in trade corridors that seem to be important. We want to revive trade, international trade. And there's some mixed messaging about the digital economy. Let's just say we don't like the tech giants. Not sure that that's a really good idea, given that they've helped also through this recovery. This is my own view. But be that as it may, we're going to also help businesses adopt or invest in digital technologies, including retail and so on. So in summary, just going a little bit over time here, in summary, you know, we have a lot of challenges, you know, and those challenges are structural challenges, let alone the pandemic, you know, and I think a lot of those are being pushed to future generations. This is what worries me a little bit about the, let's say, the social fabric even of the country. You know, future generations are going to face higher CPP, that is, you know, public pension plan contribution, higher carbon levies, whatever they're called, the whole climate, the impact of climate policies on resource jobs. We're going to have to transition from that, a tough job market, higher cost of education, and so on, and you know, the gig economy that is still not addressed through EI reforms. All these things are left in abeyance and aside in this budget. We're going to be awash with debt at the end of the budget period, and we do hope, and there's a chance that the investments we're making are going to be worthwhile in terms of boosting economic growth, but the government itself doesn't seem to be making a big of a gamble on that in their revenue projections. Sorry for going 2 minutes over time here, but that's my overview.
Yeah, no, thank you very much, Daniel. I think that is a fantastic overview right there. I mean, I think we will have more people with questions, so we'll come back to you. With that, we'll move to our next speaker, Jennifer Poon from Scotiabank. Jennifer is Director Advanced Planning at Scotiabank. As Director Advanced Planning, Jennifer oversees national tax support for advisors and relationship managers and leads the business and family advisory services offering. She also provides technical support and coaching to the BFAA specialists, thought leadership, policies and procedures, and other tactical support for the team. And with a dual role as the leading subject matter expert for wealth management taxation, Jennifer works in partnership with Scotiabank's team of specialists to provide tax and real estate and estate solutions for their clients, delivering total wealth solutions. So that is quite a lot of stuff that you do, Jennifer. We would like to hear all that distilled, you know, quickly for our audience. And absolutely, I think, you know, I think a lot of our audience, you know, would be potential customers of Scotiabank or of some of the services that you offer. So, you know, I think we're definitely interested in understanding your perspective and your view of how this budget can impact our lives from a taxation perspective in particular. And also, I think taxation, you know, enables us to do things. It's almost as if people change behavior based on tax, rules and tax structure. So what should we do to make sure we're on the right side, or we optimize our taxes? And I think that's what we want to hear from you. And then we will go to questions. So over to you, Jennifer. And if I did forget to mention something, please feel to add to your bio there.
No, thank you. Again, I echo Daniel's point. Maybe this is a good chance to review our description, our CV. But in short, I work with Scotia clients too. Most of us are, so the BFAS group, it's actually a business owner specialized group. So we work with mostly business owners and high net worth family. My specialty is in tax planning. And because of Scotiabank's footprint, we also have a lot of international clients as well. And so what my main job job is to advise our clients on tax policy, where things are going, where some of the tax planning opportunities might be. So to echo a lot of what Daniel is saying, tax policy, and Vijay, I completely agree with you. Tax policy is part of economic policy. It should influence behavior. So to our finance minister's credit, I think it is a bit, we find this budget to be a lot of nothing, and yet a lot, 732 pages of consultation and ideas. There's a lot of ideas that was just thrown at the table. And then to echo a lot of social policy, I think it was, and this is my personal opinion, it was largely politically driven. For most of us, even at the local Tim Hortons at the CD Howe Institute, a big question was, how are we going to pay for all this? There was all types of tax speculation, ranging from, are we going to raise the capital gain inclusion rates from 50 to 75%? So those of us who have enough gray hair, remember, it wasn't always 50%, it wasn't even 75%. And I think there are economists that did enough research to say, hey, if you do raise it, it's going to change the replacement, the capital equipment replacement rate. And to that end, they did introduce policies. So this is, from a tax perspective, they introduced something called immediate expensing. So one of the tax policy they did to that extent, instead of raising capital gain inclusion rates, or the other thing that was hotly debated was housing. So the principal resident exemption was also up for debate. So there's something in here with the housing as well. So I mentioned the immediate expensing. So they're actually going to allow businesses alike to expense about $1.5 million of what would otherwise be amortized. So it's actually kind of a bit of a give me to the business's perspective. That's a great tax break, and it's frankly a little vague in a tax practitioner's eyes, but it's mostly applied to almost all classes of assets except for land and building. And so it's a good tax deduction for business owners. It should also encourage, stimulates the economy to buy more equipment as well. To the stimulus relief, and again, I echo a lot of Daniel's points. Is it a bit of an overkill? So every program is extended to the tune of an extra 52 weeks. You can look at, and if you look at the slides on our website, we now following COVID measure relief program for business and individual, like it's a religion. It's daily update. I got a smile out of Daniel. It's a daily update. There's more letters and acronym than we can think of now, and they all contradict one another. But I think the most, just to highlight a couple, what we have known as the CERB a year ago as something new and interesting is now the Canadian Recovery Benefit. So one of the things that was news in my world as well was when people started getting CERB, there was no withholding on it. So as we're all filing taxes now, you have noticed the people that are getting CERB, it's now called a Canadian Recovery Benefit. Now we have to pay taxes that people didn't recover for. And because the original guidelines was, I'm going to say quick to the gate rather than loose and vague. They were quick to the gate, and to their credit, perhaps they just really cared about people. There were some administrative mistakes to the tune of a lot of people got it, a lot of people are now having to pay it back. So to that, they did try to fix it. They said you had to repay that, you can now take a deduction, and there's a bit of flexibility as well in the year that you have to repay back or in any year. So that gives people a bit of flexibility. They extended EI sick benefit as well. What was also new for business owner was that the SUS, the wage subsidies. Now they extended that, but they also introduced a hiring program. So the hiring program, if it's on the next slide, you'll see everything. On the hiring program is 50%. If you were to rehire, they'll give you a subsidy of 50%, but it's one or the other. So now for a business owner, unless you have a big corporate department and you have a couple of lawyers and a whole finance department at your disposal, most small, medium-sized business owners are having to look at what's better and what do I apply? And then how do I do this and what paperwork I have to file? The rent subsidies, I know is a bit of a challenge as well. It's kind of a dune bogo as well. Moving on to some personal, just quickly going through some personal, also on this page that was interesting is the lockdown support. So for those of us who were in a lockdown situation and couldn't work because of it, there's an extra 25% for you. So while this is an overwhelming, suite of program, again, I echo Daniel's points, is it too much, and how we're going to pay for all this? And it kind of continues. I'm just going to touch on maybe two more extra tax credit on a personal level. The working benefit credit. So that was introduced about a couple of years ago, I think about 5 years ago. And so they're going to increase that from 26 to 27 cents for anything over $3,000. So that if you were to file your tax return or you're reviewing your current tax return, you're about to file, it's one of the non-refundable tax credit. It goes to reduce your taxes paid. There's going to be a phase out. What the other interesting thing on the next slide is actually OAS for anybody that's over 75. You are now getting an extra $500 if you're at least 75 from now until in 2022, and there's going to be an extra 10%. So they really try to focus, like Daniel said, the students are getting the student loan to interest relief for another year. There's continued grants for training. They're for working benefits for older seniors. There's also a whole lot of spending on long-term care on those who the government consider to be hit the most. But what I think was even more interesting was, this is a bit of a personal observation. I make it a bit of a hobby to look up finance minister's background, and I've read a couple of Christina Freeland's books. So having that, you would expect something. We were rumoring, the NDP was rumoring about a wealth tax, and now wealth tax never came to be, but the luxury tax came to be. So we've actually entitled it Closing the Wealth Gap, or closing a couple loopholes. So to that end, if you are interested in buying a luxury car or a private jet or a luxury yacht for that matter, there will be an extra tax next year. To that end is actually the importation tax. So the funny thing is, and I'm sure, Daniel, you're on that call, perhaps we're on a different call, the finance, and because of the COVID, we would typically be in lockdown reviewing the budget, and that didn't happen this year, but there was an immediate technical call at 4:30 on Monday, and the Automotive Dealer Association was very concerned about the luxury tax as relate to a luxury vehicle over $100,000. And again, to just echo Daniel's point about the digital, I don't really. I'm a little puzzled myself as to what kind of signal we're sending to the digital community and to big data in general. In the fall, when we had the fall economic statements, which kind of act like a mini budget, the original form of the digital tax was in form of sales tax and was streaming. It was for subscription and for app. But in the budget that was released on Monday, it became a temporary digital service tax. So the tax is now going to be proposed, is going to be 3% effective beginning of last year. And it's actually going to be taxed on companies that make revenue doing digital data and any of that services. So again, echoing the point, wondering where the message is coming from. So moving on, again, I think this particular tax policy has to do with targeting the too big to fail type of a situation. There is an interesting bit about interest deductibility, and this really target bigger corporation, where they said you now cannot deduct interest that is more than 40% of your EBITDA. They're going to put a fixed ratio in there. And that, again, to target, there's a number of practices for multinationals where there would be hybrid debt or mismatch type of arrangements where they're getting additional benefits. But the next slide is really where most of our concern is. Like I said before, the majority of the interesting thing in this budget was there was no tax changes, there was no tax rate, and frankly, we're already over 50%. That's typically kind of the threshold. We're in Ontario, we're at 53.5. How high can you go? What's on the slide is generally what we call entry avoidance rule. So if you talk to your accountants, typically we call it GAR, General Entry Avoidance Rule. And generally what it just says is, although it's allowed by the Income Tax Act, if the series of the transaction or the transaction you're about to partake, main goal is for tax evasion, we're going to consider it illegal. So in the past, what will happen is you may have a very smart tax lawyer that came up with a very smart arrangement that it's legal, and then CRA would audit you and you would take it to tax court. That process takes time. Now the new approaches, and mind you, this is actually something that is discussed on a more international level. So the OECD countries, they actually have this project. This is actually one of the action points in that BEPS actually referred to base erosion profit shifting. So it's largely driven by the practice. I know, Vijay, you own a software company. Google was famous for having a company based in Ireland, so shifting some of that. So this is largely driven from that. So instead of them saying, hey, we're going to audit you, we're going to take this to court, now there's a case precedent, what they're actually now saying is you must report anything that may be unusual to us. So now there's mandatory disclosure on reportable transaction, which is a term we've always had. Generally speaking, is anything that says if your transaction, or this is a series of transaction where there's a tax promoter, there's promoter and tax benefit, this person may actually get paid as a percentage of that tax benefit. If this whole thing is to evade tax, you need to report that to us so we can audit you, so we can take you to court. What is new is notifiable transaction and uncertain tax treatments. So these two things are from international tax. In the US tax, they already have such a thing called a notifiable transaction. And generally speaking, it's meant as something of interest. And I tie that with uncertain tax treatment, because then tax treatment is really for bigger corporation. There are, like any piece of legislation, there's usually a lot of gray areas or areas that are not testing or not fully realized, or the Tax Act has not come up with the current times. So there are typically certain areas that companies and individuals may take. Perhaps the objective wasn't to evade tax or fraudulent in any means, but they're uncertain. So why is this whole page of concern to us? Instead of they coming after you, they're going to make it a taxpayer responsibility to report it to CRA, and so they can look after you, so that they can come after you. And the penalty, and it could be a very innocent transaction that is completely legal and you would win in court. The penalty is failure to disclose, and it's quite hefty. It's $2,000 a week, up to $100,000. So if you didn't do this type of disclosure, and in addition to what's not on this slide, it's also of concern for practitioner, is the National Registry for Corporate Beneficiaries. So again, this gives CRA, a tax authority internationally, because there's something called CRS, the Common Reporting Standard, a lot of information, a lot of ways to look for what they think might be a suspicious or unusual event that they should audit. So to end my rant on this subject, all concerned, it gives CRA a lot of power. There's also something in the budget about testimony. In the past, it would have to be written response. Now they'll take oral response. It gives the tax authority a lot of power, a lot of disclosure. And what we're afraid to that is it is generally a taxpayer's right to save taxes. And so what this type of disclosure would do is deter taxpayer by using legitimate legal means to go after tax savings. And if we could just maybe skip to the next slide, to echo Daniel's point, there is tons of tax incentive, a lot of programs for the green energy to zero emission. And what is very interesting to us on this page is to reduce corporate rates for manufacturers of zero emission products by 50%. So if you're in the right business and you make what would they consider to be zero emission products, so electric car, Elon Musk, you now get a big tax break. Also, what's interesting on this program is the green bond. So Scotiabank, being a financial institution, that perks our ears right away. They're looking to raise $5 billion to fund a lot of green infrastructure. To Dan's point, maybe this will pay for some of it, but who knows? A lot of it is going to be the future generation. The last little bit, and I'll conclude on this, on housing. There was a lot of, it seems like every time you turn on your phone, there's some sort of commentary about the housing bubble, especially if you live in the Toronto or the Vancouver market. It seems to spill over. Not enough, perhaps, not what we're expecting would be in the budget. Nothing to the capital gains. There was speculation as to the principal resident exemption as well. There was speculation that there's going to be a cap or just getting rid of it altogether. Like the United States don't have this. But instead, there's a little bit of a benefit that you get 36% in GST rebate, but only in a very certain limited window. And they put a condition on it. It has to be for primary residents. The tax on vacant residential, or they call it unproductive use of residential property, I think it's of most concern for most people in the GTA and Ontario and BC. Now, we do believe, although this is under consultation, we do believe this is going to happen because we already have existing laws in BC and in Ontario, specifically in the GTA and Golden Horseshoe area. And what it says is there's going to be a 1% tax on the property that's owned by a non-residents, non-Canadian residential use that are considered to be vacant or underused. And it's going to be up to you, the property owner, to make an annual declaration to say that it is being properly used. There will be an exemption if you have a qualified tenant in it for at least a year. So our concern here, while we agree that this, we think this is going to happen, it is certainly relevant in certain markets. It may not be relevant in rural Saskatchewan. Is this relevant for every market? So I think I've adequately used up my time and a little more. So I'm going to hand it back to you, Vijay.
Thank you very much, Jennifer. And I think I want to let everybody know that's watching. Please send us your questions. If you're on the Zoom call, there's a Q&A section here that you can put in your questions in. If you're on Facebook, send it in the comment section there. So we have a couple of questions. Daniel, I'll start with you. This question is, we at the as a preemptive measure to the, it's preempting the budget. We had a newsletter go out last Saturday, and we kind of had a feel of where this budget is going to be going. So we wrote to our audience, our members, and we referenced MMT. You probably know of MMT, the modern monetary theory. Stephanie Kelton and so there is a whole theory which talks that all these things about finding the financial resources, federal government should budget like a household, deficits harm the next generation, deficits crowd out part. So all these are dogmas, right? In the new MMT world, if you're spending the money in your own economy and you're printing your own money, it shouldn't matter. So what is your take on MMT? And it seems like, if you looked at it from an MMT lens, I think what Chrystia Freeland has done is kosher, if I may call it.
Yes, you can look at it that way. I certainly encourage the viewers to look up a very recent study that we did on MMT that basically explains that we published, and it's actually one of the authors was with C.D. Howe and now is with Scotiabank. I'm just want to mention that as some kind of a brain circulation here happening, but it is a very recent study, and it explains why this is, superficially, of course, interesting in that, well, as long as inflation doesn't rear its ugly head, if that's what you wanted anyway, if that was the target of the central bank anyway, why don't we open the spigots and allow, in this case, recent case anyway, the central banks to help finance the deficits that we need to, for example, fight the pandemic. And I think that a lot of the debate would be around something like a legitimate debate would be around something like, well, okay, but a lot of these deficits are for so-called investments, and that would be, under any theory, not a bad thing, right? I mean, we tend to think of infrastructure, but maybe daycare is infrastructure. Probably training is infrastructure of some kind, right? You build a human capital. And so, there would be less difference in terms of how the government, the federal government, is applying this MMT theory than a more standard government. I mean, I wonder how our conservative government would have done. Look at what our conservative government did in the last recession, right? You open, you have to invest is what you call it, right? So then the danger is more with MMT is when things go back on track, right? Whose responsibility is it going to be when, I think it's a question of when we get more inflation, when interest rates start rising, when people start seeing that all of a sudden the cost of the debt service starts rising, meaning you pay taxes, you don't quite get the services because you have to pay the interest on the debt. When you start seeing that dynamic evolving, I don't know if it's going to be in the next year, maybe 2 years, 3 years, 4 years, who's going to be actually, and then, costs are going to rise, who's going to actually be responsible for reining this back in? And MMT says, really don't worry, the fiscal authorities are going to be able to reduce their deficit. And rein in economic expansion, price increases that way. And the question is, well, what's the historical evidence that governments on the fiscal side, as opposed to central banks, are really able to do that? So that's just my take in a nutshell. I understand why it's what's the word I'm looking for? An attractive explanation of where to go right now and how we should do this. But I think we're going to still pay the price down the road if we make the wrong investments, if debt is rising, if inflation is rising. And then all of a sudden, people might look at MMT as a bit of a pipe dream, in the sense that it doesn't make us avoid the hard choices down the road.
Thank you very much, Daniel. And Jennifer, you obviously heard of the same thing. I mean, it says there's no upper limit on the state's monetary borrowing as long as the government debt is denominated in its own currency. Central bank can print more money to avoid default. Additional printing of currency doesn't necessarily have inflationary consequences. Now, to traditional economists, and I've studied a little bit of economic theory myself. It seems that this is all counter to traditional which they call dogmas right now, but traditional theory. So what is your stand on this? I mean, is this real? And if it is real, then we're probably being too conservative, because this may be the answer out. So Jennifer, your answer.
Well, it's so I'm going to caveat everything is I'm not an economist, but the interesting thing is even before the pandemic, this whole idea of a modern monetary theory has been floating around, and was largely to describe from, again, caveat, we're not economists, the U.S. economy versus the Canadian economy. Mm-hmm. And it seems like I remember at the beginning of the pandemic, besides, we're all scared and locked our outdoors, Because we were covering the COVID measures for our clients, for our customers, business, and the like, we were following this daily 11 a.m. Press release. And at some point, there was a journalist, and I believe it was CBC journalist, that asked Justin Trudeau, will you be raising taxes to pay for this? And he has straightly said no. I remember that. I think I actually recorded that moment. And instead, they're going to rely on a low interest rate to pay for all this. So I think I echo Daniel's points. Like I understand the theory. However, I mean, who's gonna it's still debt. It might be numbers on a page, but it's still numbered in the ledger. When and how are we gonna pay for this?
Okay. So thank you. This was like a very high level view on the budget itself, on the economic theory behind it. So MMT, we've got a bunch of people saying we need to look at this in a little more detail. So I have another question for you, Daniel. This is more in terms of, low hanging fruit. I mean, you've talked about the messaging to the digital world, but if we've got 35 million people, 30 million Netflix accounts, even if we charge a $1 per month from each Netflix account, that's 30 million a month. That's $500 million a year. So I mean, it's easy money. Nobody's ever going to sweat it. Nobody's ever going to. The customer's not worried about paying an extra dollar. Why do you think it's a problem?
Well, no, there's two different things. So there's this so-called Netflix tax, which is really a sales tax, yes, right? The way on your digital transactions, right? The only thing that I think is wrong about it right now is that actually there are studies. This is quite relevant now. It's a bit of a curiosity, but there are studies that say actually please encourage people to stay at home and watch things. Hockey games, great. Why do we keep the National Hockey League going? It's because it's like 1.2 million Quebecers staying at home every 2 nights, and that's good for ending the pandemic, right? So I'm just being a little bit facetious, but I would have not actually have agreed with the timing, because people rely on the digital economy to actually live under these restrictions. But in general, and we published studies on that too, fairly recently, you got to level the playing field between the digital economy, a transaction, especially with a foreign provider that's now they're going to have to be registered in Canada, but may not have a physical place of presence, right? That's why they were not taxed. So that's one thing, and in principle we agree with it. Timing questionable. The other thing, however, is this digital services tax, which is, in my view, something that the UK has also been trying to do, that the US is pushing back very much against. And what it is, it's an attempt at addressing, because the OECD can't agree on tax apportionment and exactly the BEPS initiative, that Jennifer mentioned, where you have basically some multinationals that are really located for tax purpose, or where a lot of their revenues for tax purpose are in low tax jurisdiction, or in the US or some big, and then they do a lot of business here or in the UK, Starbucks and others, but they don't actually collect taxes there other than the sales tax, right? No corporate tax. So this is an attempt by Canada to emulate, I think, the UK on that score. We're going to get a lot of pushback from the Biden administration that is actually trying to repatriate more tax of these tax revenues to the US rather than see them go to Canada or the UK. The idea is to get us to all talk together, which I think we've been trying this for a good 5-6 years now, to see how there can be more apportionment, higher fair taxes and more corporate taxes, and more apportionment of these tax revenues among the countries where all these, especially digital businesses, but a lot of others are actually located versus where they do business, if you see what I mean. This is our attempt to get our fair share. There's other things about the digital economy that I'm not so sure, but this is this is, I think, where they're coming from on this. Starting, I think, Jennifer, you said January 2022. So
It is, yeah.
yeah, I think it's going to be
And
quite
then
discussions.
I think it's a fair cash tax grab. If there was one that you can call it, if there's any way you can call it,
Yeah, it actually has a more structural debate behind it. And so, Daniel, actually, to your point, because they've been debating it for so many years, it almost feels like Canada is jumping the gun a little bit. If you guys can't agree, we're going to do it. UK is with us, right? So the structural side of it is for taxes, most jurisdictions collect taxes where the revenue is earned, where the revenue is digital and it's in around the internet. So I'm based in Silicon Valley, but I'm supplied to the rest of the world. So the rest of the world are missing out on that tax revenue. And that's why, we would expect the Biden administration to be strongly against it. So the rest of it, it's been a strongly debated, and it's driven sales tax the same way. Sales tax is typically collected where the transaction occur. Use Amazon, for example, where if you're buying from somebody, Amazon in China, it's made in China, sent in China, so it's done on your app. Where's the server located? So now the original proposal for the sales tax was that it's going to change the point of sale to where the fulfillment center is, which makes Canada having the authority to collect. I think so. So it's a more of a it's a long time coming. It makes sense because everybody, it's digital economy is one of the economies that is growing because of that pandemic, along with healthcare and biotechnology. But it's also a long time coming, I would say.
Thank you. So again, point of consumption, point of the last mile, your warehouse, digital, so it could be multiple things, but I think the thing being where you're consuming it is probably where you're the user, you pay for it. This can be debated. I think you're saying the dust is still loose on this one. We'll figure that one out. But I think directionally we're going towards. If a Canadian consumer is consuming a product, the Canadian consumer should pay a tax, and the government should have a say in that, which I think is what governments around the world are looking at. And I think it's a reasonable ask. I think it is something that also can quickly add up from a numbers perspective from a government. So I think we'll do that. So we're kind of coming up to time. We got a few, around 10 minutes more, 8 minutes to be precise. I have a couple of questions to Jennifer. Jennifer, as a member of the Indo-Canada Chamber of Commerce, some of us run businesses. I think a lot of us run businesses. The immediate expensing, right? The up to $1.5 million. What do you recommend? How do you maximize this? What do we do? Like go buy cars? And what is it that I think you said, property is not included. So what is included? What can you go and buy and expense right away up to $1.5 million every year?
So with any tax policy, their finance like to be a little vague. So they actually just announced that it's a majority, we believe, actually most classes of equipment in the tax act you would be able to write off immediately. Obviously land and property, land and building would be to the exception because they're quite expensive and that will be a bigger tax break. But it's not a matter of, I would say there's a view that if you were to replace an equipment, perhaps because the technology is out of date and that was stopping you, this should give you the incentive to upgrade your equipment and that would help the economy as well.
Mm-hmm. Absolutely. No, I spent some early years in my career in India, and in India at that point they were trying to get wind energy. So if you invested in windmill, you get 100% depreciation. So I think it was things like that that is being attempted here. Now coming to Daniel quickly, one question about the pivot to a green economy. The pivot to the green economy, Norway has shown us the way. Norway has done that. They've actually pivoted to a green economy. So it is possible that and Norway was as resource heavy as we are, and they did it. So can Canada pull a Norway? And we had Aeronaut Tool here at this very webinar 2 weeks back, and we asked him the same question. And he said, he would have liked a more hybrid model, I think, which is what you're suggesting as well. But what do you think? I mean, are we trying to go from driving a gas car to a full electric car without, going through the hybrid stage? And I think this question for you, Daniel.
Well, my own take on the comparison with Norway is that the Norway train has left the station. If we ever were going to compare ourselves to Norway, we should have thought about it like 30 years ago when they started actually saving all the money from the North Sea oil instead of spending it. Now that's a big debate in Canada, but unfortunately, it's kind of the to use another metaphor, I mean, the horse has left the barn, and whatever that metaphor is, closing the barn door after the horse is left. So basically, I think this is why it's tougher for us. We didn't save on our as much of our non-renewable resources when I suppose we had the chance. There's a whole debate in Alberta, of course, as to whether they should have had a sales tax, a more stable revenue, et cetera, et cetera. That's looking backward, unfortunately. Mm-hmm. Looking forward, it's a very ambitious, and now the government is doubling down on its emissions targets, but and they are giving businesses and investors support for really, it is a bit of a gamble. What is Canada going to look? What does a green Canada going to look like? Well, that's very interesting. It's going to look very different than what we are now. There are some provinces, like Quebec, that are giving us a bit of an idea what this might look like. Does not mean, in my view, or no oil extraction, was certainly no. It doesn't mean no gas or oil even exports, or LNG. It just means we're going to offset them. It just means we're going to develop those kinds of technologies, and like, for example, capture and storage. And there is promise there. And because we're running out of time, I'm just going to say it's a big technological gamble, right? That if we are going to force more electric vehicles on the road, we have a study coming up on that. It's going to be a big change over the next 20 years, if not before. Well, we need to build infrastructure for that. Maybe we need to change our supply chain. Maybe that will create just as good jobs or better jobs than what we have now. But it's almost like a moonshot. There was no cost benefit analysis of like going to the moon. It turns out that there were a lot of benefits, but it is a gamble in economic terms, and I think we're doing it, of course, for the right reasons. But it's and they're trying to encourage the transition. It's going to be tough for the economy. There may be, of course, that technological silver lining and the good jobs at the end of the rainbow. Tough transition in between.
Thank you very much, Daniel. I think you've hit upon a lot of those points that we've been all thinking about, and as economists, you put it in the right framework. Jennifer, I have a last question for you. As the Indo-Canada Chamber of Commerce, and I think it's true of some other ethnic groups as well, we love real estate, right? So what is your take on real estate? Now, do you think Canadians own too much real estate? Are we real estate poor? Because I think today, if you do, there is a affordability crisis. But if you look at, there is a lot of people that have actually invested in a lot of real estate. There's too much real estate. There's too much. So where do you think, based on the budget, based on the direction that you see in the budget, where do you think people should be? What is your take on that, and what would be your advice to our members?
Yeah, so in wealth management and most of, in financial planning theory, we talk about diversification. So without directly commenting on real estate, I mean, I live in Toronto, I live in Etobicoke, so we're all in this together. We see this. Without commenting on a particular sector, it's always better to, not have all your eggs in one basket. So that being said, I can, share an observation with you. We actually have a lot of high net worth clients who made a lot of money in real estate. Specifically, we have builder clients, and we have clients that are, I have a client that specializes in pre-construction condos, and she sells them and she owns them. She has about 700 units in her portfolio. Wow. And it became time for her, she's actually one of our best clients, to come to us and say, I think I've owned enough real estate. It's time for me to turn into equity. So if I were to observe from the budget as well, it could be, and Daniel, I thought it was really funny when you said it's a moonshot, because this person who's also famous for electrical vehicle just run a big contract with NASA. I don't know if you read that as well, along with the other A company. He didn't get it, but the EV people did. But it's interesting. If you were to look at this budget, apparently you should really be investing in green energy. Vijay, maybe we should go back to the windmills and to that extent, to anything, because you're getting a 50% tax break. You're probably going to get a lot of grants and a lot of support, and that seems like that's where the government's pushing.
Thank you very much, Jennifer. And you know what? I'm going to give you both a quick 20 seconds to give some closing remarks. So Daniel, and then we'll go to Priya. 20 seconds closing remarks on the budget.
Well, it's not the worst of times. It's the worst of times out there for a lot of people. But in fiscal terms, I think they did something. Look, it's not middle of the road. It's not also as ambitious and maybe dangerous fiscally than it could have been. But sticking to my story that there's another shoe to drop. We don't know whether these investments are actually going to create a lot of growth, the transition to green economy. And so, we do think the government could have been more prudent, given that the provinces will need a lot of fiscal room, and given all the challenges that I described that are coming our way, demographic and others. Having said this, I think there's also a tax credit for green housing. So if you're looking for a housing angle and a green economy angle, maybe you can combine them.
Yeah, it's $40,000. Yeah, you can get $40,000 to retrofit your home. So I totally agree.
The same thing. If you want to do a quick 20-second on just an overview of the budget.
Yeah, I totally agree with Daniel. I think the budget's typically economics policy as well as social policy. It should influence social change. I think there's a lot of social influence in this policy more than others. From purely a tax policy perspective, as a tax practitioner, as we're advising clients, there's not a lot in this budget, which we keep anticipating. Tax revenue is a way to one of the easiest way to pay, other than not paying under your monetary theory or through bonds and issuing, raising capital. So we keep waiting for how we're going to pay for this, and I don't think we have a clear answer. So as a taxpayer, and I am a taxpayer of Canada, I would be on a bit of an edge for the next couple of years.
Thank you very much, Jennifer. And with that, I'd like to introduce my colleague, Priya. Priya is a director at the Indo-Canada Chamber of Commerce, and she also serves as a district vice president of Scotiabank, leading a team for 15 branches across Midtown Toronto, and is also the program champion for Scotiabank's Women Initiative. And she joined Scotiabank in 2016, Director of Customer Experience, and she's had lots of leadership roles at Scotiabank. With that, over to you, Priya, and you bring this home.
Okay, perfect. Thank you so much, Jennifer, and thank you, Daniel. That was an amazing overview of the budget and how it'll impact so many different groups, including our audience of small business owners. Thank you also to our sponsors and everyone who's participating both on Zoom as well as on Facebook Live. This was definitely an informative session, and if you are a first-time viewer, as Vijay alluded to, we do have Thursday Talks every Thursday, of course. So I would encourage you to join those. and make sure that you're learning about all of the various topics that are topical both to the Canadian audience, as well as folks who are working with businesses in Canada and India, because that's really a main focus for us at the Indo-Canadian Chamber of Commerce, to build those bridges and to make sure that we're providing all of you with topics which are of use to you in your daily life and daily business. So thank you again to our speakers. Thank you to the sponsors that you see on the screen, Tagentia, our technology sponsor particularly, as well as SBI Canada Bank, Vijay Wealth Advisory, ICICI Bank, Seneca, TELUS, GT20, PTC Punjabi Canada, as well as, of course, Turkish Airlines and the Weekly Voice. I hope that everyone enjoyed that, and please do let us know your comments or any additional questions. You can write to the email address listed there. Have a wonderful day, everyone.